I am biased to long-term rentals over time because they're the most stable with the least amount of risk. And they can be managed relatively passive. I am a doctor of physical therapy. I'm a dad of one daughter, one on the way. Time is a premium for me. And so my investments are not as lucrative or maybe not as powerful or accelerated as some other investors, but this is the plan that works for me right now. And so when it comes to rental properties, there's 5 profit centers. There are 5 ways that a property makes you money every single month. Number 1 is appreciation. Appreciation just means that a property gets more valuable over time. The historic national appreciation going back many years is about 3 to 4% per year. If you think about it, 50 years ago, the median home price, the average price of a house in America, has gone up dramatically. And that's because that appreciation keeps going up over time. Why does appreciation always go up? The short answer, there's a finite amount of land. The United States is a finite amount of land. And as you develop that land and build more houses, there is less available space. Less supply, increased demand, prices go up. There's other factors like inflation, the cost of the dollar, things like that. But historically, 3 to 4% year over year. For my market, Jacksonville, Florida, our historical appreciation is about 4.3%. So it's pretty favorable if you're an investor. Second way that it makes you money is depreciation. Depreciation, we'll dig in more later because there's a lot of kind of little pieces about it, but big picture, depreciation is the wear and tear on your property over time. The IRS allows you to deduct a fixed amount per year over the life of the property. They anticipate a regular property will completely wear out over 27 and a half years. So this means that the value of the property, for example, $100,000 over 27 and a half years, will lose a fixed amount of value over time. What this does is this lowers how much taxes you have to pay against the profit in the rents that you brought in. And in addition, when you go to qualify for loans in the future, the underwriters will let you count that depreciation back as real income to help you qualify for your next loan. So it is kind of imaginary money that helps you get more money in the future. It's great. And we'll talk about it more in the next kind of rental breakdown series. The third thing is cash flow. This just means that you're bringing in more money than you're spending. You're bringing in rent, you're paying the mortgage, you're paying the insurance, the taxes, you're having your maintenance reserve, your vacancy reserve, your property manager, the lawn maintenance if you're responsible for it, the garbage if you're responsible for it, and all those things. That leftover amount is your cash flow. That's how much profit you're making on a monthly or a yearly basis. That amount, you can run numbers to calculate it back into how much it cost you to obtain and get the property rented, and that helps you compare apples to apples. Okay, is this a better investment or is this a worse investment strictly on cash flow? Again, it's one part of the equation. So if you're more on a short-term time span, cash flow is a little more important than if you're on a longer kind of time horizon for your particular goal. Generally, your cheaper properties are going to have larger cash flows and a better return on your investment. But those cheaper properties are going to have less appreciation over time. Quick example, if you have a $100,000 house and it goes up 3% in appreciation, next year it's worth $103,000. So you gained $3,000 in property value in 1 year. If you have a $300,000 house in the same market and it appreciates 3% on year, well, that's $309,000. You picked up $9,000 in 1 year. So because it is a higher price point, you're multiplying, or that would be a 3x gain on the appreciation piece of the pie. That property may have less cash flow, but you're capturing that appreciation. If you think about that over the scope of 2, 5, 10, 20 years, the effects can compound very quickly. The fourth category of profit center is debt paydown. When you have a rental that has a mortgage Your tenants are helping you pay down the mortgage. Right now, you can lock in 30-year fixed rate mortgages. That means that from now, for the next 30 years, the interest rate will remain the same. The rent will help you pay that down. So the balance will go down over time. Generally speaking, over time, the house gets more valuable over time. The rent increases over time, but that interest rate will stay nice and flat. So if your numbers work now, they will continue to work for many years to come. That's why it's so important to make sure you run your numbers right and set it up correctly at the beginning and your first time. Because then it can snowball in a very positive and powerful way. Number 5 is inflation protection, a hedge against inflation. Last year, 2022, the stock market took an absolute beating. It said that the average investor lost 38% of their portfolio in the S&P last year. That's crazy. Last year, myself, we lost $0. In fact, we purchased 2 properties to add to our portfolio. We renovated and placed a tenant over a property turn in one of our properties, and we sold 2 properties. The stock market doesn't, the ups and downs of the stock market, the value of the dollar, inflation in a sense, those things don't affect you quite as fast in real estate. It's because real estate is largely illiquid. What that means, the stock market, you put your money in, take your money out, money in, money out. And that's what makes it so volatile, because it's so liquid. The prices can move all over the place very dramatically. Housing, it takes a lot more steps to qualify for a loan, find a loan, put in a contract, go through the underwriting process, close a loan. So people can't take their money in and out of housing as quickly, which is what makes it more consistent and predictable and stable as a long-term investment.